Louis Namwanja Chizito, who is a financial analyst as well as a lawyer. And we from there, we're going to be speaking about venture capital investment. Do you know why is this so on this particular day? Yes, as you're relaxing on this particular day, being a weekend for many of you at least, you need to understand that, hey, investment is not a joke at some point. And you boosting up your small enterprise, you boosting up your startup, at least you need knowledge to know on where you're going to be investing at some point, where those funds are going to be coming from as a particular point again. But as we also interact more and trying to understand a lot about investments and how startups can continue to boost themselves, you realize that, hey, it is high time for also government to do something on towards this one. Now let us kick start it with Louis here. Thank you so much for joining us and giving us your time.
Welcome.
If you could assess for us, you have written about venture capital investment in one of your articles I have seen. How do you see the assessment towards the adoption in Africa? Let's kick start it from there.
All right. Venture capital investments in Africa for the first quarter, at least, it has heavily grown. I think in the first quarter we raised as a continent 1.8 billion. That's an improvement from even what the entire amount we got last year as a continent. So venture capital investments are booming as an asset class of investments are booming. Why? Because the continent is full of young, vibrant people who want, and businessmen look at this big population as an opportunity to scale their business. And venture capital is all about scaling a business. It's about scaling a business, and basically it bases itself on how many people can I get. Any business that is in that is venture capital back is normally a tech related business, all high risk, because venture capital normally goes to risk capital that goes to small businesses. It's a form of equity financing, but it's a specific form of equity financing that is, the larger spectrum is equity financing, but then there under you have venture capital.
Okay then. And about liquidity and as well as financing in that regard, explain to us the difference between, you know, this venture capital investment and then we've got individual investments. Because according to my understanding, I can invest in myself to do something or to convey something or to boost up something. But where does venture capital come in now? If you could now explain fully for the public to understand the venture capital investment and where does it differ from my personal investment or individual investment?
Venture capital is a form of equity financing, like I've just stated already. And it's fundamentally different in a way that when I'm a venture capitalist, or if I'm going to put venture capital into an enterprise, it is I'm supposed to get shares in that business in return. Now, if I'm going to get shares, that means I will have to exit my investment at some point at a return. So it's a form of equity financing, and again that is raised in rounds. It's not a one-off. You see, general equity financing, where I just get shares like private equity, it can be a one-off. I give you shares and that's it. And you give me shares, I give you money and that's it. But with venture capital, it is raised in rounds. You find that there is a seed stage, then there is a series stage where you have had that maybe like Safe Border, like Ensiboko, like Cheaper Cash. These are enterprises that actually are backed by venture capital. But they do not raise money once. It is a series of rounds. There is a round one, which is early stage. Then there is the qualified rounds, which are could be from A to Z if you are that attractive. But normally in Africa, it's 1 to C, or we don't really not go to beyond the 3 stages of that round. Then you have the maturity stage, where it's all about, like I said, scaling and expanding your enterprise.
Okay,
and
correct me if I'm wrong, Louis here. According to my understanding, a venture capital is where some firm or some organization, or it could be anyone or government or any expert, is going to give you money, support you with that money. In return, you bring back the money, but with interest. Is that so?
Interest Not entirely.
Okay, please.
But it depends on how it is structured. Like I said.
Okay, what are the characteristics here in this kind of venture investment, in capital investment?
The major characteristics are if I'm a venture capital fund.
Okay then.
And I'm going to give you money. Or you'll get me shares in that business. You get me the shares, how do I benefit? It is as simple as make sure on the next round of raising money, you raise enough and I exit at a higher value than I gave you. Let me give an example of Safe Border. Safe Border raised money in they incorporated themselves here in Uganda in 2014. They raised their first batch of venture capital, which was a form of debt that is convertible at interest again. But the interest here is shares. You get more shares in return. When they raised that money, about $200,000, that was in 2015, how did the early investor benefit? He benefited when they raised money in 2018 on the next round, and that actual, what they call the early stage money they gave them.
The initial money injected.
Exactly. It finally converted into shares, but again, for them, they exercised the option of just getting the money. Because when they raised money, again, I told you it's in rounds. So at each round, someone is exiting. At each round of venture capital, new money is coming in and an earlier one is exiting. How does he benefit? He leaves with more money. He's cashing out. That's they call it an exit strategy in venture capital. It's an exit strategy. Some of the exit strategies can be if there is a sale of the company, of the tech startup, or if there is an acquisition, or there is a merger. Or in extreme cases, like you saw what happened to Jumia in the US in, I think, 2018, when they did an IPO on the New York Securities Exchange. Most of these venture capital funded startups, you will see them going public to raise money to help the earlier investors cash out.
Now, as the earlier investor, how is the best way, what is the best way of tracking those particular cash outs like you're mentioning? How effective can I track those strategies you are aligning to make sure I am tracking down what is leaving back? Because as you're explaining to us what I'm picking, as new entrant, the money is coming in, the other one has to go out. How best can I track that I'm not losing or making losses here?
You see, again, it's not hard for you to track as a venture capitalist. Because whenever you're backing a company, there are metrics that they follow. There are valuation metrics that they follow. There are all sorts of aggregator platforms that show that this is the kind of investment that is put in this company. For instance, if you go to Y Combinator or Crunchbase, some of these websites actually indicate who has invested in the company. But again, the problem with data about startups and how many startups that have got venture capital backing is that most of them don't publicly announce. So as a company, as an investor, you cannot lose track of your investments. Remember, these are professionals. A venture capital fund in most countries is structured like a partnership, a limited liability partnership.
Okay.
So there is no way you can fail to track really if you have made an investment. And venture capital is long-term. It's a long-term investment.
And you highlighting for me, it needs an expert here. Now compare for us, or where do entrepreneurs, because we've got people like entrepreneurs, we have got expert investors. Now in this case, maybe the ones you're calling experts. And then there is none of the two. Someone could be watching, is neither an entrepreneur nor an expert in a venture capital or any investment plan here. Where do they integrate here? Or how can one partner with the other to make sure they tap into that space? Remember, we're into boosting venture capital or embracing that particular culture around Africa.
Well, the culture is already there. It's growing. In fact, Africa is the only place where you can highly scale a business, because the only problem we have, our education levels are low. But on the general scheme of things, this is the continent where the population is big enough for you to scale an enterprise. But that having been said, how does a common person fit into the equation? Most early stage venture capital businesses are looking to raise venture capital actually start from raising venture capital from family, from friends. That early stage where an idea is very nascent and you need people to trust you. And normally what the ordinary person does, he comes in at the earliest stage. Rarely would you, Where rarely would you find established institutionalized venture capital funds or companies, if you want to call them that invest at such an early stage. So what happens is, at that stage, if you're going to raise money from family, friends, and maybe an NGO that feels that you're a social enterprise, they give you something called a convertible debt instrument. And NSSF has done it with their High Innovator Challenge. They gave, I think the challenge ended last month. They gave around 3, 4, 5 startups that had pitched good ideas to them, $30,000.
And that's just the funding.
And that's just the start, the funding. But then it's a convertible debt or convertible grant, or it's an agreement for future equity. So how it is structured is that I give you a contract. And that contract stipulates that I'm not going to get shares now in your business, but when you grow.
Like after 5 years of your...
It could even be 5 years of growth. If you reach some revenue targets, if you get a new investor, this contract stipulates that my money will either convert into that the shares at that point. When you get a new investment, they call them liquidity events. At that point, when you get a new investment, or when you reach the target revenues, and NSSF did this last 2 months ago, then once that happens, once that happens, which is called a liquidity event, then eventually your money can eventually convert into shares in the company. If it's not converting into shares in the company, then someone can choose to cash out.
Okay.
At that point, when you get the new investment. So the ordinary person normally comes in at the start of the entire venture, when you're going to undertake the journey. Once you have been trusted by your peers around you, and then you want to raise more money to scale, because I said venture capital is for highly scalable businesses. By scaling, I mean businesses that have a high growth potential. And tech businesses...
So this neglects SMEs. You're telling me this neglects SMEs, because I wanted to know to what extent does venture capital influence wealth accumulation towards SMEs?
Venture capital, you see, like I've told you, there is no reason why an SME may not go for venture capital.
Okay,
it can. Though the preference for venture capital is for high growth, high risk startups. But if you're a small enterprise, an SME that has grown to a certain stage, you don't have to wait and start as go for a convertible note. You can actually apply or make a pitch to investors, and you go in for a qualified round. I think my friends in Sivuko have actually done it. They went head on for a real venture capital round without even waiting for the pre-seed stages of, I think they raised about $700,000. So
how important is it? It's like, can't I do away without it even when I'm an established firm like you're speaking about? How important is the venture capital? What additional value does it create towards my business growth?
One, venture capital. There's no bank in this economy that is going to give you a loan when you're a high-risk, early-stage business. That is one. And venture capital, don't confuse with any other form of financing, is exclusively for high growth, high risk business entities. And preferably, these are businesses that are in the tech world. These are the ones that get it. And most of the venture capital, by the way, in countries in Uganda is coming from places like the United States, like the UK, South Africa, other areas. In Uganda doesn't have a fully fledged program, a venture capital program. Much as there is something I've had, but doesn't follow venture capital principles. I think the Youth Livelihood Venture Capital Fund, something of that sort. But I have not seen any business that can say the money I got from this Livelihood Venture Capital Fund follows the principles I'm talking about. In fact, the people I talk to see that their investments are structured as a loan. And venture capital is not loan money per se. But again, how does it benefit your business? This is long-term money. It is patient capital. It's for high risk. It can help you scale your business. Like I said, venture capital is about is intended for businesses that are high risk and can grow very fast, have high growth potential.
Because I tend to learn you mentioning the word high risk at least quite more often. What kind of risk are we speaking about here? I might be thinking that my business, is high end, but again, I might not know the risks involved. Explain to us the kind of risks you mean.
By high risk, I mean, when you're an early business, the venture capital startups, their failure rates is, I think, of every 10 that are started worldwide, 6 to 7 fail. Of every 10, 6 fail. Why? They are early stage. A lot happens when you're starting a business. You don't have financials. Someone is investing on you on faith. Not like when when you're going to when you're going to do an IPO. MTN did an IPO last year, but they showed you these are the financials, these are the profits we have made, this is the management structure for venture capital at the very early stage. You don't have these financials. You do not actually have this documentation. So that is the risk I'm talking about. Someone goes into the risk of a business that's just starting, not established like MTN. And is investing in you at the stage where you have no financial projections, where it is basing on the growth capacity. You have pitched an idea, but even when you scale and you reach a Series A, it's very possible. And again, these businesses that venture capital backed are highly, they are risky. I've just said that they're high risk, but again, their failure rates are high. I've also said that, but they tend to be capital intensive. Very capital intensive, because any technology startup that's why they keep on raising money in rounds, and at the stage they're experimental and they deal with innovation. And not all of innovations eventually are marketable. It might be a good idea, someone might fund it, but then along the way you don't become the next Facebook. Facebook became Facebook because it raised venture capital. Twitter became Twitter because it was venture capital backed. Uber became Uber because it was venture capital backed. All the tech startups
and you're
you see in the world.
you're giving an example of MTN, which recently at least introduced its IPOs, that is their public offers. But again, at some point, from the public perspective, to what extent do I trust all these offers at some point? Because there is a risk attached that, someone will think that the interest there, if you could, as from a financial analyst perspective, to what extent do I go trusting all these public offers displayed even on these particular platforms?
One, your Capital Markets Authority Act Section 90G, because I'm a lawyer by training, states that no one shall offer shares to the public without a prospectus. By the time MTN offers its shares, it has undergone scrutiny by the regulator, because the regulator approves the prospectus. That prospectus documents the growth potential of the company, the financials for the past 3 years. And in Uganda, only profit-oriented businesses, profit businesses list. Businesses have 2-3 years of profitability. If you have not had profits for 3 years in Uganda, you're not going to list on the stock market. So the risk of failure is literally very minimal. You can't list today and then in 1 year you are down. But the risk of equity, of IPO, of investing in shares on the stock market is that shares go up and down. You get? And the good thing about the prospectus is in there they make adequate disclosures. So you have time to make up your mind and read up. In venture capital at the early stage, the disclosures aren't there as much because you're starting out. Even when you have scaled to the level of cheaper cash, which is now I think a Series C, they raised $100 million US. They're I think the second most valuable startup in Africa after Flutterwave. Again, people are not investing in you because you have high profit margins. No, they're investing in you because they see the potential of scaling and exiting on the next round when the valuation of the company has gone up, and then they exit at a higher valuation than they bought the company at. Okay, then. If you can, that makes sense.
Okay. When we return from the break, Louis is going to take us through why, or advise us through as a financial analyst, why would I go for venture capital and leave stock markets, or leave investment around stock markets. We return from the break to discuss from that particular angle and more in regards to boosting venture capital around the country.